Hello fellows, welcome to my channel. This channel is entirely dedicated and created for educational purposes only. Here you can find high quality educational materials to learn the basics, whether you are a beginner, more advanced or an intermediate trader. For people that want to see more action, you can check the link on the top right corner. Here we are proving our methods with real accounts. We trade for several years and we show that it can be done profitably. You can subscribe as all profits go to our subs. You can find all the details about our accounts. However, since you are new in trading, using real money is almost forbidden. Practice will make you better, and do not expect fancy cars and fake promises. Trading is real challenging and the numbers are against you. You won't need any money to start and everything is totally free. For most of our videos, you will find a link in the description that will lead you into a more advanced version of the video, but as beginners, I do not recommend. Stay with the basics and demo trading. So let's begin your journey. There are several types of indicators. In this episode, we will give a better look and we will see how to identify the most suitable ones. We will see several categories: trend following indicators, momentum indicators, volatility indicators, indicators that measure the strength of a trend, the momentum of the market, liquidity, and so on. The list is really big and the information is too much, especially for beginners. I promise that we will see all of them in this series. But first things first. The major categories are two: leading and lagging indicators. You already know the basics as we have analyzed the most important indicators. A lagging indicator gives a signal after the market makes the move. Now of course you will ask, okay, then why we should check the lagging indicators? I mean, what we want is to predict where the market will move in the future. Well, you will see, trust me. The second category are leading indicators. A leading indicator gives a signal before the market makes the move. Since the market moves in waves and forms trends, a lagging indicator must be used in this case. For example, MACD, Bollinger Bands, envelopes, ribbons, and so on. On the other side of the leading indicators, RSI, Stochastic, Williams R, OBV, and others. Again, we have analyzed all of them, and some of them might be new to you. Don't worry, you don't miss much. There is no magic indicator that works best. The major problems with leading indicators are false signals. So while the lagging indicators give the signal too late, the leading indicators are full of wrong signals. So what to use? In trading, excitement and disappointment comes together, I'm afraid. Usually, leading indicators are called oscillators, while lagging are trend following. Most of the times, they will be on the opposite side. This will give several mixed signals and eventually won't be helpful in your trading. Another general rule is that lagging indicators don't work well in sideways market. That's why they are trend following indicators. So in this case, leading indicators is most likely what you need. Leading indicators perform best in ranging markets. Remember what we said: when there are important news ready to come out, just deactivate all of them and wait. A leading indicator is not some kind of magic device. It uses a set of data that help you forecast the future market activity. We use them to predict changes into the market before the market makes the move. The principle is really simple, and this is what I want you to keep. The market changes momentum first, and prices will follow. Oscillators will give overbought and oversold signals based on a specific set of data for a specific period. In simple words, it will oscillate between extremes for a given period. An oscillator will usually signal buy or sell, with some exceptions when the oscillator is not clear at either end of the buy or sell range. Stochastic and RSI and others, as we said. As momentum of the market begins to slow, fewer buyers or sellers, depends the trend, willing to trade at the current price. A change in momentum is often a signal that the current trend is weakening or running out of steam. This doesn't necessarily mean that the trend will reverse. Each of these indicators is designed to signal a possible trend reversal, where the previous trend has run its course and the price is ready to change direction. Here is the most common mistakes new traders do. That's why the same indicator will be interpreted differently by a new trader and a more experienced one. Most of the time market doesn't reverse. Now you can combine that with the trading sessions and what we have said in previous episodes. Most probably the market is taking a breath, most likely to continue in the same direction. This will be the first thing you will observe in the market. In this example, the oscillator keeps giving overbought signals. However, the market is keep trending and going higher. Even though indeed the change in momentum is causing the prices to follow, the trend never reversed. This is one of the major problems with leading indicators, false signals. If you decide to short the market based on your signals, your account would have been heavily damaged. In this example, I have put them side by side. You see that a simple trend line would have beat them. Stochastic is based on high to low range of the time period. RSI uses the changes from one closing price to the next one. This is the issue with oscillators, and that's why most of the times they fail. The mechanistic rules cannot work so perfectly. Most of the trader changes the values to avoid that. Indeed, we gave examples several times in our series on how to adjust the values, but this won't help you so much. Everything is obvious after the market makes the move. I think that goes without saying. A lagging indicator tends to move behind the prices. A moving average, for example, will follow the prices. That's why we call them lagging indicators. There is no doubt that these kinds of indicators are also not perfect. In a trend, you will be killing it by using a simple MA, but the market is not always in a trend. In sideways conditions, you have no chance. So what we need is to spot a trend the soonest. Lagging indicators will provide you with that information. In the same example as we have an established trend, we see that lagging indicators work perfectly. Now again, sorry for waking you up from your sleep. When the market is live, you don't know where the prices will go. In this example, I just found an uptrend. When the market is running, you don't know where it will stop or reverse. You obviously see how the market in this part was moving sideways. So considering taking shorts or longs at these points would be meaningless. However, when you are in the market, you don't know the future price movements. So when the market is ranging, then you should be prepared. Do not enter and exit again and again by hoping that you will get another trend. This will whipsaw your account. Don't chase the market. When you have been stopped, it is done. Move to another setup. Now you might see that eventually the market moved in the right direction and you missed it. Well, it is what it is. You might see several fake outs. Some of them might be indeed very juicy breakouts that you miss. A good hunter will pick his praise and his shots. Not all of them will bring food to the table. The market will be choppy. Again, don't chase the market. Many traders are using technical indicators as part of their hunting equipment. Not all of them will work. A good combination is a good start. Lagging indicators will be good when the market is trending, while an oscillator will provide you with a better insight when the market is ranging. Of course, you know how to use the most important lagging indicators. Searching for the perfect one makes no sense. It will make you just quit. The market won't respect any of the values you enter. A leading indicator is full of false signals. So the answer to the question is that you have to combine what you have. In a trend, you will want to go with the trend. When the market is stalling, it doesn't necessarily mean it will reverse. Oscillators will be in opposite direction with lagging indicators. However, there would be cases that they line up. A smooth trend is what we are searching. This will come in time. A juicy breakout in the prices will also be a good option. In future episodes, we will see more advanced patterns to help you identify your own trading style. A leading indicator gives signals before the new trend or reversal occurs, but not with accuracy. Statistical probabilities are what we are searching. A lagging indicator, on the other hand, gives a signal after the trend has started. Use what most traders use, a typical MA or EMA, RSI, MACD and some Bollinger. Try to keep your charts clean. The more indicators you put, the more confusing will be for you. Test your idea always in demo accounts. Combining indicators will not help you so much. Keep some basic rules. Try to identify the market structure. I know, this is the hardest part and it will take several months. We will also see price action strategies and more advanced trading ideas. More experienced traders read the market differently. Even though we are not always winning statistically and by using discipline and correct money management techniques, we survive. The market is a merciless place. You will do several mistakes. We are here to try to stop you from most of them. In the indicators episode, we said why most indicators fail. It doesn't matter how advanced it is or it will be. A calculation is just a calculation. Thank you for watching. Go back, repeat the chapters you are not sure, and trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.